Welcome back. You're watching The Money Show on ET. Now it's time for our NFO corner. And today in our new fund offering, we'll be talking about an ETF that's a fund of fund. ICICI Prudential has launched the Nifty Low Volatility 30 ETF fund of fund. Now you may be familiar with the name ETF, but many of you may not be very clear on what a fund of fund is. And why do you need to invest in one? Even if you're not clear with the ETF, we'll get that concept as well cleared in this conversation. Let me introduce on the show now Chintan Haria, Head of Products and Strategy with ICICI Prudential. Chintan, thank you so much for once again being with us on The Money Show. It's great to have you back. So to start with, Chintan, talk to us a little bit about this new fund offering, the ICICI Prudential Nifty Low Volatility 30 ETF FoF. It's surely a long name because there are so many characteristics to this, a one-of-a-kind fund. So just break it down for our viewers first up.
So it's a unique fund, like you mentioned. It's based on the concept of low volatility, which is a smart beta factor. And as we had actually discussed in, I think, one of your previous shows, the concept of smart beta is becoming more and more popular. And we have the Nifty Low Vol 30 ETF on our platform since 2017. Which is essentially, as you all know, ETFs are, traded on the stock exchange. And for trading an ETF on the stock exchange, you need a Demat account and a trading account. And in India, as you would know, very few people still have Demat account and trading account. It is an increasing trend, no doubt, in the last 1 year, but still there are enough number of people who do not have a Demat and trading account. So for those investors who do not have a Demat account and trading account, who need to invest in a low volatility kind of a smart beta product, we felt that the fund of fund, which essentially invests in the Nifty Low Vol 30 ETF, is a good platform. And with that thought process in mind, we are bringing out the NFO of the fund of fund. The fund of fund is a very simple concept wherein the fund of fund, any investor who is investing in the fund of fund, that money gets invested in the ETF, which essentially is mimicking the low vol 30 index. So essentially, those investors who are looking to invest in the smart beta concept of low vol get an exposure to that through the fund of fund, and the taxation also remains the same because any fund of fund which is investing in an ETF with minimum 95% equity investment, the treatment is the same, which is an equity taxation for the fund of fund.
All right. So ICICI Prudential already does have the Nifty Low Volatility 30 ETF. What would be the difference between investing in the FoF and the NFO, which you're launching right now, which is an FoF, or in the fund that I just mentioned?
The ETF is already in existence, but there are many investors who do not have a Demat account and trading account. Also, there are investors who want the convenience of investing via systematic investment plans, which cannot be done in an ETF that easily. You'll need to basically enroll with the broker for the systematic investment plan units to be bought on the exchange. So with all that thought process in mind, we felt that the fund of fund, which invests in the ETF, ultimately gives those investors who do not have a Demat account an exposure to the smart beta strategy of low volatility. And as I had probably mentioned, the low vol as a concept is something which is gaining ground within the smart beta strategy because we all like stability in our life, stability in our finances. So this is essentially bringing stability in the stock selection of the 30 stocks that are being basically brought. So essentially, an investor gets exposure to the 30 stocks which are stable, which are low volatility among the top 100 stocks. So you're getting exposure to blue chip stocks with low volatility. And we've seen in the long run, at least as far as the index is concerned, it has been able to deliver a better risk-adjusted return to investors who stay in the long run. So that's the thought process behind bringing in the NFO of the FoF to give those investors who do not have a Demat account a chance to invest in the same strategy. Of course, those investors who do have a Demat account also can invest in this. It does not preclude them. But we felt that there is a need or a growing demand for this product among the people who do not have a Demat account as well as those who have a Demat account but want to do an SIP, etc. And hence we brought out this NFO.
Okay. Chintan, I'm looking at the presentation, and when you say low volatility, it obviously means that these are the stocks. These 30 stocks don't really move much. So when there is low volatility, usually it indicates that the risk factor is low. But you have marked in the riskometer this fund as being very high on the riskometer. So what's the the reason or the rationale for that?
As far as the riskometer is concerned, anything which has equity at stake will get characterized as high risk, because obviously it has equity, and hence from an equity allocation perspective, that's how the riskometer is calculated, and it will have a high risk. So I would say that equities in general as an asset class, because it is considered high risk, people actually have stayed away from it. But if you invest in the long run, it has been able to deliver an inflation-beating returns. And the more important aspect, as we had probably earlier discussed as well, do not look at the rearview mirror and invest. So essentially, do not look at the past returns and invest. Invest systematically, or invest in a in a manner which your asset allocation allows. And as part of the overall asset allocation, if equities is where you can invest, then definitely this is one of the strategies which should be looked at from a fully invested equity allocation perspective. And hence, from a riskometer perspective, while it may have the high risk category because it is equity, but within the overall asset allocation basket, it will fit in well from an investor for the long run.
So now that we've spoken about risk, let's talk about the return point of view. Now, we usually say that lower the risk, lower the return, higher the risk, higher the return. And I know you've established that concept of risk and the riskometer very clearly there. But the fact is that these stocks don't really move much. Does it necessarily mean lower risk, lower volatility equals to lower returns? Or what? I mean, since it's an index fund, what sort of performance have you seen?
It's interesting. You probably mentioned twice that these stocks don't move much. I just like to probably rephrase that these stocks move lesser in comparison in terms of their volatility. So what essentially this concept is that two stocks can move from 0 to, let's say, 10, or let's say can give 10% return in different manners, right? One can be up 5% one day, down 3% the other day, and up another 7-8% to reach the 10%. The other one can be 2% up, 2% up, 2% up, or therein and thereabout. So it's about those stocks which move in a more stable manner to reach the objective or to reach the end objective. What we have seen, Mubina, over the last 10 years, 15 years, at least in terms of my interface with investors, the volatility of equity markets brings in the greed and fear. And that's when the fear aspect impacts when volatility comes in. And hence, whenever the markets fall and those stocks which are more volatile fall a lot more, investors tend to take out money. And hence, to avoid that, a low volatile product, which essentially means that they are more stable companies, they'll probably have lesser drawdowns as well, is a better fit for investors who are probably more afraid of volatile markets. And that's where this is a concept wherein the stocks do move, but they move in a manner which is less, let's say, volatile and more stable. And ultimately, at the end of 10 years, 15 years, while the journey for both the volatile stocks, the momentum stocks, the value stocks, the growth stocks may be the same in terms of returns, it's just that the journey is a bit more smoother when it comes to the low volatile stocks. And that's where this product is a good fit from an asset allocation perspective and an investor's equity allocation.
Okay, so yeah, I stand corrected over there. These are just more stable in nature. The movement over here is a little more smaller, and that's the reason why the journey as well is a bit more stable as opposed to violent fluctuations, which we do tend to see sometimes in the index, and of course in the other stocks as well. So given all of this, and actually before I talk about suitability, one more question. Who do you think, or rather, what are the other factors that are looked at in this Nifty 100 low volatility 30 index? Is volatility the only criteria? What else is looked at? And also, what's the mix then between, large cap, or I presume they're all large cap stocks, of course, since it's a Nifty 100.
Yeah, so essentially it's a very simple product. The universe is the top 100 stocks, which essentially means it's a large cap product with blue chip stocks as the universe. Out of the 100 stocks, the 30 stocks which have lowest volatility in the last 1 year are picked up, and there's an index provider who do the calculations, and we follow that index. And if we look at it from a stock selection perspective, the beauty of this product is not just the stock selection, which is basis the low volatility. The weightages of the stocks are also basis the volatility being lower. So in other words, a stock which has a low volatility gets a higher weight. And we've seen in the past that if a stock by virtue of being a high market capitalization becomes a large part of the portfolio, that itself can bring a lot of volatility in a particular stock's performance if the higher weight stock, just because of its size, kinds of underperforms for a while. So here the thing is, every 6 months there is a rebalancing which is done basis the index provider's calculations, and the 30 stocks which are part of the portfolio, the weightages are also generally in the range of 3 to 4.5%. So you don't have any stock which is too high or any stock which is too low. It's a good blend of 30 stocks. The diversification also is in place. And if we look at the sectoral composition also, it is well represented across many of the sectors which are there. It's not concentrated towards a particular sector. So that's the overall mix of the particular fund. And we've seen the advantage of such a fund being part of an overall allocation for an investor for the last 3 years. And hence we are bringing out the NFO of the fund of fund so that a wider universe or a wider set of investors can invest in it, and it can actually be invested by all spectrum of investors. It's not any one spectrum of investor, but across the spectrum, we've seen investors being interested in this strategy.
Right. Okay. Well, okay, on that note, I think we are out of time. So Chintan, thank you so much for joining us and, sharing this comprehensive explainer on this NFO that is being launched by ICICI Prudential. It's a pack of stocks that are the least volatile stocks in the Nifty 100 index. And it's an FoF, so those individuals who may not be having Demat and trading accounts as well can invest in them. Thank you once again, Chintan. And